Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. I don't think we can get enough content on real estate investing, the tax impact, and what to do if you own property. It's so important because I think that not only is it becoming more popular to invest in real estate, but also it's just a much more long-term strategy. It's something that a lot of people are dabbling in, want to learn more about, and it can be overwhelming. It can be intimidating to get into this world because it feels so complicated. Not only do you need to know about properties, property management, how to find deals, how to get deals, but you also have to understand that on the back end, that there are tax implications, tax consequences of these simple decisions that you may not know about. And there are certain ways to take advantage of the tax code to be in your favor and to be more strategic as a property owner. I've had several guests on the show talking about just generally real estate, property management, property ownership, and the tax implications of all of these things. But I want to continue that by offering some more fresh perspectives. So today on the show, we're welcoming Pat Leung. Pat has 2 decades of professional tax and accounting experience. She has a special emphasis on real estate, private equity, and financial services. She's worked in supervisory and management capacities in the Big Five, now the Big Four, and regional CPA firms, as well as in large private equity real estate firms. So she's served multinational corporations. She's done the macro, the big companies, as well as small businesses, partnerships, and individual real estate investors. So she has seen the whole spectrum of different types of clients. And today on the show, we're going to unpack a little bit about short-term rentals, a little bit about what it means to be a property owner and what to keep in mind. We're going to be talking about ways that you could just unpack the tax code for your benefit. And we're going to distill this in a way where not only will you learn a lot from today's episode, but it should provoke some curiosity so you can dive deeper into the things that matter to you. So without further ado, let's hear from Pat. Hey, Pat, welcome to Keep What You Earn.
Hey, thank you for having me on the show.
Of course. Can you just introduce yourself for our listeners? Let them know who you are and what you do.
Yeah, sure. So I'll share a little story of how I found my calling in my career. So one day in probably either junior high or high school, I come home from school and I found my parents' tax returns on the dining room table. And I took a quick look and I found errors. So seriously, kid doesn't know anything about taxes. It's probably just mathematical errors or spelling errors. And I said to my mom, I go, you guys paid somebody to do this, but it's wrong. And then I go, this is only a few pages. It's a few pages because I have immigrant parents who made like peanuts and they'd probably filed a 1040 easy back then. I go, this is a few pages. How hard can it be? Let me try to do it myself. So I go to the school library. Now I'm dating myself. And there are IRS publications scattered around the library. So I asked the librarian, I go, are these free? And she said, yeah. So I took one of every pamphlet. I took them home. And I read publication 17, cover to cover. And I found a ton of examples, the simple rule, the examples in it. But what if this? And then again, another example, stories, but what if that? And then there's all these little hypothetical examples. And I thought, oh my God. Look at all the stuff you can do instead of just saying, this is what I make and now here, tax me on this. But there's a bunch of different strategies, bunch of different rules that you can follow to reduce your tax liability. That's awesome. So, back then, got no friends, got no siblings. What's a kid gonna do except read IRS publications?
Right.
So I read it. I love it. And flash forward, years, decades later, I ultimately got my master's degree in tax, and that was my favorite program. Up until then, I was a very underperforming student. Nothing really appealed other than tax, and I got to master's program in taxes. And I'm like, are you serious? Like every single class is about tax? That's amazing. So I signed up, got in, finished it, and here I am.
I love it.
Doing, yeah, and with the focus throughout the whole thing, my focus has always been finding ways to reduce taxes, not just dumping numbers into a software that produces a form. And, I never believe in that. I always find ways to bring that liability down.
Yeah, and that's what people are really paying for. Because I think that they pay a tax professional, they think they're getting what you're describing, but for the most
They're
part, they're
not.
not. They're getting a publisher, not a co author. They're getting somebody who will just put it on paper, right?
I call them certified data dumper.
Ooh.
They are
That's true.
certified. Most, if they are getting a certified person,
Hmm.
but they're dumping data into a form and out comes what I call the damage. Every April 15th, that's what people are signing up for to get the damage.
Just tell me what the damage is. Yeah. And that's what too many people interpret as what tax season is supposed to be. And it should be
Right.
much more collaborative. It should be much
Hmm.
more integrated with advice around the whole year. We always talk about that on the show. Like if you don't have somebody in your corner the whole year round, then all you're doing is paying someone to enter numbers into a spreadsheet or numbers into a
Right.
software that you're giving them. And that's only as good as what it sounds like.
Right.
So, one of the things we're going to talk about today is how you can help reduce your tax liability with a
Mhm.
specific way. We were talking about this because Pat is particularly an expert working with business owners and with folks who own investment property. So I wanted to
Correct.
have her on to talk about how you can actually not just reduce your tax liability, but just how you can leverage investing in real estate to fulfill an overall strategy while also reducing taxes. And I want to talk about, we were kind of introducing this before we hit record and chatting about how to approach this topic. And one of the ways was kind of looking at property ownership as kind of a process or an evolution. So I wanted to let you talk on that, Pat, and just share like what it means to be a real estate investor from the beginning, how you can evolve as a property owner.
Most folks who own property usually started with owning their own home. Okay. So for somebody who buys their own home as a primary residence, they get to write off a mortgage up to $750,000 a mortgage. And they can write off property tax. Of course, there's a limitation now. Um, the combined property tax and state income tax cannot be more than 10,000. But there's a little tax court ruling that sort of takes another spin that's on that 750. Um, it is per tax return. So, for example, if you and I went and bought property together, we're not married. You get 750, I get 750. So combined, we can actually buy a property with a combined um, mortgage of 1.5 million, and we each can write that off. Versus if you went and bought a property for 1.5 million, you can only write off the interest up to 750.
And
Little
it's the
side note,
interest, right? When you say right
it's
off the
the interest,
mortgage, you mean the interest,
the
right?
mortgage interest. Yeah.
Right.
Yeah. Now, let's take that a little bit further. Um, Say I have my home and I am going to go away on a lengthy vacation, and I'm going to put up my home for Airbnb for anybody to rent it. And say somebody comes in and say, Shannon, you want to come over to stay at my place? I rent it for you for 10 days. That rent you pay me because there's a rule of 14 days or less. If I rent mine to anyone for 14 days or less, I don't have to pay tax on that income. So, and for real, I have clients where um, a few of them in LA, they've caught, their homes are immaculate with, one lady has a pretty huge lot property, caught the eyes of the movie studios. And every year they go and film on her property for about definitely less than 14 days. Um, I don't remember exactly how many, but again, let's say they film for 10 days and they pay her 5,000 bucks a day. That's $50,000 because again, it's less than 14 days. That 50 grand, it's tax free. Now she will
Mhm.
get a 1099, but then we will cite the Internal Revenue Code saying because it's less than 14 days, none of it is taxable.
Exactly. And that's the Augusta rule, right?
Yes, it's the same Augusta rule. So again, take it for, let's say, a business owner and have another client has a restaurant. Every year they host a party for their employees. They have about like 50, 70 employees, and they host it 3, 4 times a year for like Christmas, summer pool parties, and Super Bowl Sunday. They host it at their house. They bring in food trucks, and then they can write off the fair market value if they were, let's say, to rent a venue elsewhere and pay that facility X dollars. And then now they are using their home for business, then the corporation can pay X dollars to themselves, the homeowner. And because, again, less than 14 days, it's tax free. And the corporation gets to write it off.
Yep. And let me poke a couple of like nuances to this too. So is this only the Augusta rule only primary residence? Like meaning it has to be just the primary
Or
residence, or can it also be another home you own?
vacation rental. I
Okay.
mean, like a
So you can do
vacation
up
home,
to
14 days.
yep, up to two
Yeah.
homes, or is it more than that?
That's a good, interesting question. I have to look into the nuances of that. We're in California, not many people have a second home. They can barely
Mhm.
afford the first home.
Yeah, I always wonder about that if like you can just bounce around like 14 days here, then 14 days there, then 14 days like host retreats for your company and all these different
Yeah, for
homes,
the
right?
uber rich
But
who've
also
got a
like
home
how
in every
many
state.
yeah. Yeah. We can see what the limit is on that. I'm aware of primary residence and a
Right,
vacation home, but I don't know if it goes beyond that. And also the it's such a useful strategy because as long as you're under that 14
right.
days, and it's 14 days in total. So
Per,
it's not like
per year,
14 days for your
per
business
year.
per
Yeah,
year, right? Per year. 14 days for your business and 14 days Airbnb, that would not
right,
work. That would not
right.
work.
Yeah, so now let's cross into the Airbnb section, okay?
Right.
Now, for Airbnb, we have sort of two schools of people. We have those who say, yeah, I want to buy like, a cabin in the mountain and I want to use it on the weekend. And meanwhile, I'll rent it out when I'm not using it. And then
Mhm.
you have the second school of people who where they buy it and it is completely 100% earmarked as Airbnb use. So
Yep.
in the first school of people, again, they have to be aware of that 14 days. So now the rule is more complicated. It's the greater of 14 days or 10% of total rental days. So, for example, if they've only rented it out for the whole year for only 10 days, they got to do 10% of that and they can't use it for more than 10%. That's not a lot. Um, Now, if they do that, then the expenses, the mortgage interest, the property tax, everything related to the house, at that point gets split between kind of lumped with primary residence, and then the other portion would be lumped as like a traditional rental investment income property. But they don't get to expense everything, thinking, "Hey, I'm just gonna quote unquote put it up for vacation rental." Um, you know, and with Airbnb, but it doesn't work that way. But compare that to folks who are actually do renting it out fully Airbnb, then yes, they get to, of course, they have to report all of that income. But at this point, the 750,000 mortgage restriction no longer applies because at this point, this is a rental property now, and there's no limit. You
Right.
can buy a 7.5 million property for all it matters. And in fact, I have a client who bought a 1.3 million property in the nearby mountain. Um,
Wow.
yeah, and he got it just in time for ski season, and he did six figures in just the last 6 months.
Wow, that's
Yeah,
amazing. I think that people are there's always this kind of assumption, right? That if you're gonna, earmark something for Airbnb, it's like an all or nothing thing. Like, am I gonna rent it out or am I not gonna rent it out? You can do a few days, a few weekends, and actually add up to that, use the Augusta rule, for
right,
example, right? And not claim the taxes or not claim the income on it. But when you're going like full-time Airbnb, there's also a lot of expenses that you get to deduct as
right.
well that I think people miss all
Yeah,
the time. So could you go into maybe what to keep track of if you're going to go the Airbnb route? how to make the best use of that from a tax standpoint when it comes to deductions
Yeah.
and other things.
So a very, very popular question that people ask me is, what can I deduct? Well,
Right.
interestingly, the tax code actually never lists out like a laundry comprehensive list of, hey, you can deduct this, but not that. So I tell them
Right.
there are two simple rules. It has to be one, ordinary, and two, necessary in order to deduct that as a business expense. So um, I'll get to the Airbnb expense really quick, but for example, um, if there's that expense that is necessary, ordinary and necessary to generate the business income, you can write it off. Take, for example, dog food. I have a dog, only people have a dog, cats, and dogs. Um, the pet food is not deductible because that's our personal pet, it's personal expense. Convert that if, let's say, I run a doggy daycare or I'm a dog trainer, then that dog food is a business expense. Um, Cosmetic
Right.
makeup for women, that's just personal use. I don't care for marketing people. They say I have to make themselves pretty, but no, I'm sorry, the guy can't make himself pretty. But so it's not it's not a business expense. But if I'm a makeup
Right.
artist, right, that's my cost of goods. That's what I need to rely
That's
on, and
supplies.
without that, I
Yep.
cannot generate my business. So let's take this to the Airbnb. So you got to think, what do I have to incur? What expense do I have to incur to make this place a rentable place? So first, you bought the building naturally. They probably do a paint job. They probably have to, not probably, but very likely have to furnish the entire property as if they were going to move in with furniture, kitchen towels, linen things, and um, kitchenware, bowls, pots, pans, appliances, everything that you buy that goes there, vacuum cleaner, just everything. Everything that you buy for that Airbnb is deductible. Then on top of that, probably people are using, when they're managing the rental portion, they're using paying places like Airbnb, VRBO. Um, there's another one called HomeAway. So they're paying those companies, they pay them a fee, they deduct that. They're probably accessing those websites via internet at home. So they pay internet fee, that's deductible, some portion of it, not 100%.
Right.
They're probably also using their smartphone, cell phone. So some of that cell phone fees are deductible. If it's close by, then you're driving back and forth. That mileage is deductible, and there's an app to track the miles. So practically everything that you have to incur, cleaning, you have a cleaning crew. If you got a property manager, anything that owner incurs in order to sustain this Airbnb, that's all fully deductible.
Now, is there a minimum that you have to Airbnb it? Like you have to a minimum number of days rental to deduct this stuff? Or is it just, when does it become deductible? If someone listening to this, let's just say, Pat, hears this and goes, that's amazing. Okay, great. So I'm going to Airbnb my house for, let's say, a few weekends. Let's say they're over
Mhm.
the 14 days. Like I'm going to rent it out for 30 days and the whole year. Are you telling me that in the 30 days in the whole year, and I could probably use it in between as a vacation home, but if I rent it out for like my lake house for 30 days in the year, you're telling me I can deduct my vacuum and my pots and pans and all my stuff?
Uh-huh.
Can you
I know
just
where you're leaning
go
down
into
to.
that a little
Yeah.
bit?
So let's
Yeah.
distinguish between that deduction is fully, yes, it is fully deductible, but whether or not the individual is allowed to benefit from that deduction, that's a separate story. And that gets into a more
Hmm.
complicated rule called material participation rule. So um, before I get into that, let me, if I could, um, segue into how one can benefit from deducting rental losses when I have an investment property. So, quick
Hmm.
segue, really quick. So, if I have an investment rental, whether it be long term, short term, if I have an investment property, I can deduct up to $25,000 of losses, meaning I get revenue minus expenses, mortgage, property tax, HOA, if any, insurance, depreciation, yada, yada. I get to a net number. Usually it's a loss, okay, and it's a tax loss. So if I make 100,000 or less, I can deduct up to $25,000. It's not a large number. That number was set back in 1986 and never indexed for inflation. Once my AGI goes
Wow.
above 100, I lose 50 cents for every dollar. And once my AGI, whether I'm married or
Wow.
single, it doesn't matter. It's per tax return. Once my AGI reaches more higher than 150, my rental losses get suspended. So it doesn't mean I lose it. It just gets suspended into like this little bucket on the side of what we call passive activity loss. So it's kind of like putting your money into a savings account at the bank. Like you don't lose it. It's just kind of stored there until future use. Yeah.
It's kind of frozen.
So
Yeah.
the exception to that is one, if let's say I'm a few exceptions to releasing the losses. One, if let's say I'm a business owner, like I have my firm or I'm a medical doctor, I buy my own building and now it's a self rental, then I can absorb that loss both through my business. Or two, I qualify as a real estate professional. And by that, does not mean a real estate professional. It's not an adjective. Okay. Doesn't mean whether you're a professional or not. Um, and it doesn't even require a realtor license or a brokerage license. The two simple rules: I have to do more hours in real estate than any other business activity. So in other words, I'm an accountant. If I work 30 hours at my firm, I got to do 31 hours in real estate. That's a lot of hours. That's 60 hours year round. Um, Criteria number two, I have to put in at least 750 hours or more in real estate. So that boils down to about 14 hours a week, every week throughout the year. If I meet those two rules, then I qualify as a real estate professional. And in that instance, I can have unlimited rental losses, more than 25,000. I can have 100,000, a million, no ceiling at all, to offset any other income like that.
Wow.
W-2 income, dividend, capital gains, royalties, whatever other income. That's the beauty of real estate professional status. And that's the huge buzzword, or the that's the holy grail that people want to get into to qualify as a real estate professional. Then you got to be careful. Certain states like California doesn't recognize real estate professional status. We're a foreign country without a passport requirement. The last exception is if one has a what we call a short-term rental. By definition, it's where the Airbnb is rented out for an average. Okay, it could be, some people could rent for 14, some
Hmm.
people are 30, some people rent for 2. You just have to average all of those, and if the average is 7 days or less, then it is in the tax world what we call a short-term rental. And to then take those losses, I got to meet two rules. One, I perform all of the services that any other person, meaning including more than the property manager, more than the cleaning crew, more than the handyman, or I put in 100 hours and no other individual does more than 100 hours. Again, cleaning crew, whatnot. Usually in the first year that an individual buys an Airbnb, they'll get that 100 hours easily. Okay, between buying, getting the whole place cleaned up, painted, going and scouring furniture, getting all furniture, that will easily suck up minimum more than 100 hours. By meeting those hours, and
Yeah.
usually in the first year, the owner is the one doing the massive amount of hours setting it up before anyone comes into play. Before the property manager, before the cleaning crew, anybody, before it even um, gets on the stabilized rental process. So by virtue of meeting that rule, now I can also deduct unlimited losses from that Airbnb. So say I bought the Airbnb in September, October, took me some time to fix it up, furnish it, and I have it available for rental in December. That first year, I can write out all those losses. Come
That's
second
excellent.
year, usually I have now my rental income really comes in, and then those expenses, now at that point it's normalized.
Yeah. And there's just so much opportunity there. Like there's so much opportunity to plan and to structure this, but what I'm also hearing underneath all of that, Pat, is that this is very much a I would not do it by the seat of your pants type of thing. I would understand like what is the intention for this property? Talk to a tax advisor, game plan. I'm going to spend this much time doing it. Do I need to
Oh, yeah,
track my
absolutely.
time? Do I like think about the things that you should be doing, right? That you'll have to do. It's not as simple as buy a property, rent it out, and then figure out after the fact how you can deduct everything. I think there's a lot of planning that goes into that, right?
There's a lot of planning. Exactly. Yes, there's a lot of planning. I'm only talking about the tax rules,
Hmm.
right? But there's also like overall personal financial goals. And then with Airbnb, I have to say, like in my whole career, I've never seen more Airbnb than I have since the
Yes.
pandemic. So the market, caveat, the market is quite saturated, and a lot of cities, a lot of communities have come up with restrictions. So the owner should do sufficient amount of due diligence, and not to say this is undoable. Again, I'm in Southern California. We have a client who bought two houses, literally walking distance to
Hmm.
Disneyland, and in that city, there is a restriction on properties being rented out as Airbnb. And they've grandfathered in all but I think about maybe 80 or 100 properties. And this client happened to buy two of them. So it is fully licensed and allowed. So, they're not going to change the rule because they've already allowed
Yep.
him. And that's completely kosher as opposed to somebody buying into a brand new community. There's no city law or restrictions yet, but that's not to say that come a year or two, that's not going to come about. So they need to have sufficient backup plan, preliminary planning, just to make sure, and have a plan B.
Mm, definitely. Definitely. I want to talk through again the like in thinking about somebody who wants to invest in real estate, right? They want to become a property owner and they're thinking about, renting it out. Maybe it's not part of the initial plan, but they're like, "Oh, I could rent it out eventually." Let's talk about when like when it kind of changes approach, if you will, like what we call the date placed in service in our world. Like when is something placed in service and what does that actually mean? I'm even trying to come up with the words now in like plain English on how we describe that placed in service date and what it actually does to your tax situation.
That's a great question. I try to explain it as the date that you open your business for,
You
your
accepted
company for
renters, right? Or
business.
like you
Yeah,
said we are for like the quote unquote for rent sign goes on the door, right? Like
right.
the
Yeah,
available.
right, exactly. Yeah, I always tell my clients, like, it is, it's a day that you make it available for rent. It doesn't mean that you have to have somebody rent it. So again, going back to somebody who bought it late in the year, they've got it cleaned up, and come December, they put it up available for rent. So, it's all documented now with technology. You can see when the person posted available for rent in VRBO, Airbnb. So that's going to start the day. And that's a very important day because that's when all the deductions start being allowed. So until the point that they have the place available for rent, it is the deductions are still kind of trapped and not released.
So explain that a bit. Like you can't take those
So,
deductions until you officially rent it.
right, yes. And not officially available for rent.
Right.
Again, not rented. Available for rent is the key word. So, again, take somebody and their contractor took way longer than anticipated, which I don't know any contractor who
I
finishes
was gonna
ahead of
say never
time.
heard of that scenario
Um,
before, but
yes, right. So say it took longer and it dragged on to the next year into January or February, and at that point they've incurred a lot of expenses the prior year, but we can't
put it up for rent.
write anything off. It gets pushed until the subsequent years until at a point where the property is now fixed, done, furnished, available for rent.
Gotcha. So with the that in service date is everything because that's when you unlock some frozen deductions. So
Correct.
it's not like a snooze you lose situation. It's not like
No, no,
you miss out on those deductions because it wasn't ready.
it's the
It's
timing.
just timing. So even if you incurred the expenses in
Right.
the past year, how far back can it go? Is there a limit on on those types of
There
expenses?
is no there's no limit, but um, in a single family, like a one property Airbnb, drives into the next year. But I've seen construction of commercial properties where
Yeah.
that took, obviously more than a year, and all of those expenses gets um, suspended, or placed on hold until the doors are open for rent. And people always forget there's a lot of carrying costs throughout the whole time,
Hmm.
right? And until the property is available for rent, they shouldn't forget all that because there's utility costs, there's insurance costs that they're continuously paying every month.
Right.
But people forget that, the poor accounting really costs people money.
Yeah, it really does. And that gets into kind of my one of my closing points of it's really important to understand the commitment that it takes to enter into this game
Right.
because I think a lot of people see it as this kind of sexy way to make money right now because you're seeing
Yeah.
all these
Yeah.
Airbnbs going up and you're like, I'm hearing all this stuff on TikTok and on Instagram that like I got to invest in real estate. And those are great tips, great strategies, but there's also a lot of responsibility that comes with it. And I think that if you think it's
Absolutely.
going to be a quick way to make money, I think you're sorely mistaken. You agree?
Oh, absolutely. It is not a quick get rich scheme. Absolutely not. I mean, you're talking about committing yourself to a sizable mortgage with a lender, and now you have the property, and God forbid something happens to that property. Like I'm down here in Southern California, and our nearby mountain, Big Bear Mountain. In the past years, we have had fire after fire after fire. And then now this winter storm, they have unprecedented snow. So there's always some kind of natural disaster or natural situation going on. So the owner has to plan for that,
Hmm.
right? Because right now, nobody can get up the mountain. So even if they got the Airbnb rented, nobody can get up there. So they're not getting the rental income. So people have to plan for that. It's just, you can't once you get into business, any type of business, whether it be investment, rental properties, or a regular business, you got to plan for the unknown.
You really do. Yeah, and you have to be committed to the mission, right? Like you have to you're
Right.
committing to maintaining this and I think it's one of those things you can't really abandon or it's not people will call this passive income and I understand where they're going with that term, but I don't think there's anything passive about owning real estate. In fact, I think it's one of the most active things you'll have to do. It's like getting a dog.
Well, by tax definition, it is called passive
Right.
income because in the old days, people, put aside the Airbnb world, in it's a lot. If you had a long term rental, then I could say, yeah, it's quite passive, and you buy the building. Assuming you don't have to fix it up, you buy the building that's rent ready, put a tenant in there, and every month, yes, you collect the rent check, and it's quite passive in that aspect. It's not like Airbnb where you're constantly, that's a business, and that's why the tax laws are different to allow the deduction compared to that to like a long-term rental. Then that's completely yes, pretty passive in nature.
Yeah. So, Pat, if our listeners are, curious about learning more, about finding out more about how to tax plan their next property purchase, how can they find out more about you and what you guys offer?
Yeah, absolutely. We love working with real estate investors and business owners. We offer what I call a discovery session for folks who want to come and explore whether they've missed out on any lost tax opportunities in the past, as well as planning for current year and or future years as they start getting into investing in real estate. So we map out that path for them and walk them through step by step. And there's a lot. I mean, there as much as people read and watch, whatever YouTube videos, once they get into it, there's a lot of questions.
Yeah, there always are. And I know that having a professional on your side is going to help eliminate a lot of those questions. So, we're going to
Right.
include in the link in the show notes, we'll have information on how to get on that discovery call with you. Pat, thank you so much for hopping on the show today. Really appreciate you spending your time.
Thank you so much. It's been a lot of fun.
Hey Hey there. Are you looking for more tax and accounting help for your small business, but tired of the confusing jargon or feeling judged for your questions? This is exactly why we created a completely free Keep What You Earn community centered around this podcast. This community is a space to ask questions, hop on our monthly connection calls, and explore more information about our episodes and our guests. Click on the link in the show notes to join us in this month's call to chat with me and our other guest experts. See you there. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.